So you're in the gig economy and you're looking to get financing. And let me guess, you're probably finding that it's a little bit more difficult getting a home loan when you're a gig worker. In this video, I'm going to give you the various options that you have as somebody that's in the gig economy to get home financing to either buy a house or refinance. Let's dive in.
Working for a living, living and working. I'm taking what they're giving cause I'm working for a living.
So let's say that you're an Uber driver or you're delivering for DoorDash, you're, delivering packages for Amazon. You, my friend, are what we would consider a gig worker in the gig economy. You're not an employee of a company. You're basically a contractor providing a service to another company and receiving compensation for that service. And this makes you self-employed. So in the world of getting home loans, there's a few different ways that somebody who is self-employed would qualify for financing. The first thing that we need to take a look at is your history of being self-employed or as a gig worker. In the optimal situation, you'll have been a gig worker for at least 2 years. However, if you haven't been for 2 years, it's not a deal killer. It's just that we're going to have to look at other options. But let's pretend that you've been a gig worker for at least 2 years. The way that it's going to work is on your tax returns. Let me guess, I'm betting that you file something called a Schedule C, which is something that a sole proprietor files on their taxes that basically documents the income that they're receiving for the contracted work they're doing. Like you probably receive a 1099 tax form and then, you give that to TurboTax, H&R Block or whatever, and they file that Schedule C for you. To calculate your income, we are actually going to review that Schedule E, and there's this magic formula that all lending uses. It's standardized, and we figure out exactly what your qualifying income is based off of that Schedule C. Now, I know what you're thinking. You're already freaking out thinking about your income on that Schedule C because you're self-employed, and let me guess, you write things off. So your actual net income is not going to be as much as your gross income. You're not alone. That's how everybody does it being self-employed. You get to write off all of your expenses, whereas when you're an employee, you don't really have any business expenses because you don't own the business. So don't fret if your net income isn't going to quite get the job done. We do get to add things back into your income, like depreciation, mileage, stuff like that. But basically, we would figure out exactly what your qualifying income is and average it out over the last 2 years. And then that's what you would use to qualify for a traditional home loan, like a Fannie Mae, Freddie Mac, FHA home loan. Now, that would be the most ideal scenario for you to qualify because it's going to come with the best terms, lowest rates, lowest costs, and also the lowest down payment. But let's say that you don't fit into that box. And trust me, a lot of people do not, and they still get home loans. So how are they doing it? There are all sorts of other products that we label as non-QM loans, but basically you've probably seen products like bank statement loans, loans that are based off of your P&L or a 1099. We would analyze, does it make more sense for you to do a bank statement loan? And that's where you provide like the last 12 months of your bank statements. We tally up the monthly deposits and we use that as your income. Or maybe it's a P&L loan and literally we use the numbers on the P&L to qualify you for the home loan. Now, like I mentioned, the traditional loans like Fannie, Freddie, FHA, they're going to have lower rates and lower down payment requirements. These non-QM loans are going to have slightly higher rates and you're going to have to pony up more for your down payment. So if you're struggling to come up with a down payment, a non-QM loan's probably not going to be the best solution for you. But if down payment's not your issue and it's really just qualifying as far as income goes for the financing, and because of you being self-employed, you're running into challenges, a bank statement loan or a P&L loan or a 1099 loan might be the silver bullet to get you into a house, to become a homeowner, or to accomplish that refinance that you're trying to do so that you can consolidate debt. Either way, we have all of these options available at New Way Mortgage. So if you have questions about any of these things, reach out to me. We'll get you all of the information that you need to make an educated decision. If you haven't already, do me a huge favor, smash that like button, make sure to subscribe to the channel, and I'll see you on the next video.
Working for a living, living and working. I'm taking what they're giving cause I'm working for